Have you ever wondered why a company is valued at $10 million and another is valued at $100 million, even though neither of them is profitable yet? Welcome to the channel. I'm Toyosi, and in today's video, we'll be looking at how companies are valued. Whether you're a startup founder looking to pitch your startup to investors, or even you're looking to buy a stock, understanding how companies are valued could be crucial and important. So, first, what is valuation? Valuation is actually estimating the present value of an asset or a company. Analysts will determine the future earning potential of a company and then discount it to its present value to understand how much this company is valued at. Basically, to determine if the company is undervalued or overvalued, and it depends on its historical performance, future performance, what sector or industry this company is in, before you can determine the right approach or the right model to use in valuing a target company. And there are different valuation methods. We have the asset based approach, the income based approach, and the market based approach. First, we have the income based approach. The income based approach focuses on earnings or cash flow that a company is estimated to generate in the future. And this approach is more suitable for established businesses that have predictable revenue and cost patterns. The most common type of income based approach is the DCF, the discounted cash flow method, and it's basically predicting the free cash flow of a company for a period of maybe 5 to 10 years and discounting it to its present value. So, how a DCF works basically is that you have to first predict the free cash flows of a firm for a period of 5 to 10 years, and this is done using a tool called the financial model. A financial model is a tool that is used to predict the financial performance or future performance of a company, of an asset, of an investment, and there are steps to which financial model is prepared. First, you have to collect historical data from a company. Then you analyze the historical data that you have collected, and the duration or the period of collection of the historical data could be variable depending on your projections. Could be between the period of 5 to 10 years. Then after analyzing historical data, you have to prepare assumptions based on the historical performance of the firm. Also, you have to take into account the economic conditions, the market conditions, and then you will make your forecasts. In terms of valuation, you have to forecast the income statements, cash flow statement of the firm. Then you can now derive the free cash flows that can be used for your valuation. For a DCF, you need a free cash flow for a period of 5 to 10 years and also the terminal value of the firm, because you're not estimating or you're not projecting that the firm will not be existing after 5 to 10 years. You have the assumption that the firm will continue to exist, which is why we also need a terminal value. And to discount your free cash flows, you have to use a discount rate, which is typically the weighted average cost of capital. So after discounting your free cash flows, you get your present value, which is now the value of your firm as at today. DCFs are very detailed and rigorous, and a little change in your discount rate or even your growth rate can actually impact your valuation very greatly. And this takes us to the next type of income based approach, which is the income multiplier method. For the income multiplier method, instead of building a full cash flow forecast, you basically just multiply your industry standard multiple by a chosen metric. For example, EBITDA. EBITDA is earnings before interest, tax, depreciation, and amortization. So it's your earnings before you deduct interest that you're paying for your loans, taxes to the government, or depreciation and amortization on your assets. Or EBIT, which is earnings before interest and tax, which is your earnings after you have paid or you have deducted your depreciation and amortization, but before you pay your interest on loans and also taxes. Or your net income, which is basically revenue deducted by all expenses, operating and non-operating expenses. So, for example, if your target company has an industry standard multiple for EBITDA at 10x, and the EBITDA for your target company is $1 million, you would multiply 10 times $1 million to have $10 million. So you can basically just estimate that your target company can be valued at $10 million. Next, we have the dividend discount model. Dividend discount model is specific to companies that pay constant dividend, and it basically estimates the present value of the future or expected dividends. It's of the assumption that there's a constant growth rate, which is the Gordon's growth model, or there's a multi-stage growth for maturing companies, and basically it's used to only value companies that constantly pay dividends, for example, blue chip paying stocks. Next, we have the earnings-based valuation model. With the earnings-based valuation, it basically is valuing a company based on its ability to generate earnings. And one common metric is the PE ratio. The PE ratio is the price to earnings ratio, and it's basically how much are investors willing to pay for $1 of earnings in a company. So, for example, if the PE ratio of a company is 20, that shows that for every $1 of earnings, the investors are willing to pay $20 in return. And PE ratio is usually, or the earnings based valuation is usually used for companies that are publicly traded and are also very mature and they have consistent earnings. And that wraps up the income based approach. Next, we have the market based approach. The market based approach is basically compares a company or a target company to its competitors or companies that are publicly traded or companies that have been involved in recent transactions, and it's of the opinion that the market sets a fair value. The first market-based approach that we're going to be looking at is the comparable company analysis. Comparable company analysis is basically you identifying your target company and then identifying other companies that are of the same size, of the same structure, capital structure, risk, growth profile as your target company that are publicly traded, and then you're going to compare their multiples. For example, the PE, the price to book, the EV to EBITDA of your comparable companies with that of your target company. So for example, one of your comparable companies has an EV to EBITDA ratio of 5x and your target company has EBITDA of 5 million. You're simply going to multiply 5 by the 5 million to have 25 million, and you can estimate that your target company has an EV of 25 million. So next we have the precedent transaction analysis. Precedent transaction analysis uses historical M&A transaction data. So you look at what buyers have paid for similar businesses and you use this as a benchmark for you to value your own target company. But it's important to note that buyers usually pay more for a target company when they're acquiring a company, and it's called a control premium, and it's usually just to be able to gain majority influence in that company or majority control of the company they're acquiring. Precedent transaction analysis is good for analyzing or valuing companies that you want to buy or companies that are for sale, or also for strategic acquisitions. Another way of valuing a company is the market capitalization. The market capitalization is basically just multiplying the share price of a company by its total number of outstanding shares. But it's important to note that the share price of a company does not show its true intrinsic value because the share price is subject to market sentiment and volatility, but it gives you a very good estimate of what a publicly traded company is worth or valued at. And that brings us to the third approach, which is the asset-based valuation. This method is very suitable if a company has significant tangible assets or identifiable assets, or in the case of liquidation. The first method is the book value. The book value is basically total assets less total liabilities, and whatever you have left is the value of the company. And this does not show the true picture or the true value of a company because it doesn't take into account the future earning growth or potential of the company, and it also uses historical cost. Next, we have the replacement cost. Replacement cost is basically if we had to replace this company's assets or build this company from scratch, how much would it cost us? And then you just say, okay, the company is valued at how much it will cost to replace the assets or to rebuild the company. It gives you like the floor value, the minimum value you would want to walk away from if you were leaving the company or if you were selling the company. And also we have the liquidation value. Liquidation value is basically if we had to sell all these assets right now, how much are we going to recoup from this? And that is the value of the company. Again, this doesn't show the true value of the company because the sale is probably going to be like in a distressed form and you will get distressed prices, and that's not like the true value of a company, but it just gives you an eye level picture of how much the company can be valued at. And so those are the three main approaches of valuing a company: the income based, the asset based, and the market based valuation approaches. And there are also other types of valuation approaches that are not the traditional method but are typically used in specific cases. For example, the VC method. VC is venture capital. Venture capitals invest in high growth startups. So these high growth startups are usually not even profitable, or some don't even have $1 of revenue yet, but then they still want to invest in it, but they need to ascertain how much is this company worth or is this startup worth even when it doesn't have revenue or profit yet. And this is where the special form of valuation comes in, and the VC fund will have to estimate what the exit value from this startup could be in maybe 5 to 7 years, and then discount it to its present value and then estimate this as the value of the startup as at today. Now that we've looked at all the different types of methods or approaches that can be used to value a company, it's important to note that it's not just about math, it's also about what the company is doing, what sector is it in, is there a low barrier to entry or anybody can just start offering the same product or services as this company, what's the management like, are they experienced, are they capable of improving the value of the company. So for a recap, you should use DCF if you have a company that has financial stability or financial stable projections. And if it's a company with competitors that are publicly traded, you can use a comparable company analysis. And also if it's a distressed company, a company with a lot of assets, for example a manufacturing company, then you can use the asset-based approach. And you can also use the multiples method if you want a fuller picture. So thank you for watching the video. If you found it useful, give it a thumbs up and also follow Atoyosi's Finance Nuggets. And also if you'd like me to deep dive into any of the approaches, for example DCF, comparable company analysis, just leave a comment and I will look at it and I will make a video to address your comments. And yes, thank you for watching and goodbye.